On paper, an invoice is one of the most boring documents in global commerce. It describes what was sold, for how much, in what quantity, between which parties, under what terms. And that is exactly why it matters. Because if you can manipulate the invoice, you may not need to move cash in a duffel bag, bribe a bank teller, or build some cinematic offshore maze to move value. You can move value through trade itself. That is the basic logic of trade-based money laundering. Not hiding money outside commerce, but inside commerce. This is one of the reasons the problem is so resilient. Global trade already involves different jurisdictions, currencies, pricing conventions, logistics providers, customs treatments, inspection standards, and document trails. Most of that complexity is legitimate. But complexity also gives bad actors room to distort the commercial story. The invoice becomes the narrative device. A product is worth this much. A shipment contains this quantity. The goods are of this description. The buyer and seller are these entities. The route and timing make this much sense. If those statements are manipulated, then value can be shifted under cover of normal trade. Start with the simplest version, over-invoicing. If goods are declared at a value far above their real market worth, extra money can be transferred through the transaction. On paper, it looks like payment for goods. In reality, part of the payment may function as illicit value transfer. Now reverse it. Under-invoicing. Goods are sold below their true value, allowing value to remain elsewhere in the chain or be compensated off the books. Again, the shipment may be real. The paperwork is what changes the economics. Then there is false description. A shipment may be described as one category of goods when it is really something else. That matters not just for customs duties, but for pricing logic. If the description is vague or misleading, it becomes harder for authorities, banks, and counterparties to assess whether the declared value makes commercial sense. The same goes for quantity manipulation, duplicate invoicing, split consignments, and conflicting document sets across the same transaction. What makes this powerful is that none of these tricks requires the trade to be entirely fake. That is a key point. Trade-based money laundering often works best when most of the transaction is real enough to pass basic scrutiny. A real shipment, a real invoice, a real importer, a real exporter. The distortion sits in the relationship between the documents, the pricing, the route, and the counterparties. That is why detection is so hard. No single document usually tells the whole story. Customs may see the goods declaration. A bank may see the payment instruction. A freight forwarder may see routing data. An insurer may see cargo details. A compliance team may see a customer profile. An auditor may see revenue. A tax authority may see something else entirely. If those data points are not reconciled effectively, the laundering system survives in the gaps between institutions. The Financial Action Task Force has repeatedly highlighted that trade-based money laundering exploits the mismatch between the volume and complexity of international trade and the capacity of authorities and financial institutions to assess what looks commercially normal. That mismatch is the real infrastructure of the problem. Because suspicious in trade is rarely obvious. A high invoice price may be justified by quality, timing, scarcity, or contract structure. A low price may be explained by damaged stock or distressed sale. A route may look inefficient but still be legal. A commodity description may be broad but not necessarily false. That ambiguity is useful to illicit actors. It lets them hide distortion inside the normal range of commercial messiness. And the larger the system, the easier that becomes. Think about what a customs officer, bank analyst, or trade compliance reviewer is really being asked to do. They are not just looking for forged paperwork. They are being asked, often under time pressure, to determine whether the pricing, description, quantity, counterparties, and route all make sense together. That is not a document problem alone. It is a market knowledge problem. You have to know what the goods usually cost, how they normally move, which counterparties are plausible, which routes fit the declared origin and destination, whether the payment terms are routine, whether the invoice language matches the shipping documents, whether the company profile matches the size and pattern of the trade. Without that context, the paperwork can look clean enough. This is why trade-based money laundering is less about one clever trick than about using commercial volume as camouflage. A suspicious payment by itself may stand out. A suspicious container by itself may stand out. But a suspicious relationship between value, goods, and paperwork can disappear if nobody sees all three at once. And that is often exactly what happens. The World Customs Organization's guidance on money laundering and terrorist financing stresses that customs authorities need better coordination, data analysis, and interagency cooperation because trade documents do not become meaningful in isolation. They become meaningful when compared. Compared to market price. Compared to historic trade patterns. Compared to company behavior. Compared to related invoices. Compared to what other agencies already know. That comparison layer is where many systems still struggle. And now the problem is evolving. Trade is increasingly digitized, but digitization does not automatically remove laundering risk. It can speed processing, standardize fields, and improve audit trails, which helps. But it can also increase document volume and procedural speed faster than oversight capacity improves. If bad actors understand the data fields, they can manipulate the digital paperwork just as they manipulated paper forms before. The format changes. The logic does not. So what should viewers take from this? First, trade-based money laundering is not a niche problem sitting outside the real economy. It uses the real economy as its transport layer. Second, the invoice matters because it is the bridge between goods and money. If that bridge is distorted, both the trade story and the payment story become unreliable. Third, detection depends on integration. Pricing knowledge, customs data, beneficial ownership, routing patterns, and counterparties have to be read together. Otherwise, each institution sees only a plausible fragment. And finally, the most dangerous version of the system is the one that looks ordinary. Not the obviously fake front company. Not the cartoonishly corrupt shipment. The transaction that is real enough to move, documented enough to process, and distorted enough to transfer value. That is why trade-based money laundering survives so well inside modern commerce. It does not need to replace trade. It just needs to borrow trade's paperwork. An invoice is supposed to describe what happened. In the wrong hands, it can describe just enough truth to keep the rest of the story hidden. And once that happens, the goods are no longer the only thing crossing the border. Value is moving too, quietly, administratively, and often in plain sight. That is the hidden ledger view of the problem. The paperwork is not the side story. The paperwork is the mechanism.